So now we are back, we can continue. Now let's look at the steps. Yeah, steps forward on bond refinancing. Yeah, to determine whether it's worthwhile to refinance the bond. So what are the steps forward? It involves 3 steps. 1, you determine incremental outflows, present value of cash outflow. How much do you require for you to refinance the bond? So in this case, you factor some costs such as call premium. Also, the overlapping interest charges. Overlapping interest charges. Then also the issuing or the flotation cost. Issuing cost of the new bond. You also add the discount on issue of the new bond. Then you raise the interest tax shield associated with number 1 are these expenses. 1 is the call premium. Also overlapping interest charges. Then you factor in the unamortized issuing cost of the old bond. Then you also factor in the unamortized discount cost for the old bond. Then what you get, you multiply by the tax rate. And that's how we get our present value of cash outflow. The cash required to refinance the bond. Number two, you determine incremental cost saving. And the cost saving in this case, we say that any cost you save, it will reflect to incremental earnings. So that's incremental earnings. And how do we determine the incremental cost saving? So in this case, we'll be comparing the cost of the old bond against the cost of the new bond. So you take the interest cost or interest expenses for the old and the new bond, then you raise interest tax shield associated with one is this interest. Then number 2, amortization per annum of issuing cost, as well as amortization per annum of the discount cost. Then what you get, you multiply by the tax rate. Also here, do the same. What you get, you multiply by the tax rate. Good. You get the net cost. Then lastly, step number 3, you evaluate using NPV. Evaluate using net present value. Good. So those are the steps forward to determine whether to refinance or not refinance the old bond. Good. So take out your handout. Let's do a question from the handout. Handout page 4. Handout page 4. We have a question on bond refinancing. And we are told that Mark Limited issued 100 million par value, 16% 10-year bond 5 years ago. That was 5 years ago. So it has remaining how many maturity period? 5 years. The bond was issued at 2% discount and the issuing cost amount to 2 million. Due to the decline in the treasury bill rates in the recent past, interest rates in the money market have been falling, presenting favorable opportunity for the refinancing. A financial analyst engaged by the company to assess the possibility of refinancing the debt reports that a new 100 million par value, 12% 5-year bond can be issued by the company. Issuing cost of the new bond will be 5% of the par value, and a discount of 3% will have to be given to attract investors. The old bond can be redeemed at 10% premium, and in addition, a 2-month interest penalty will have to be paid on redemption. All bond expenses, including the interest penalty, are amortized on a straightened basis over the life of the bond and are allowable for corporate tax purposes. The applicable tax rate is 40%, and after tax cost of the debt to the company is approximately 7%. Required. Cash investment required for the refinancing decision. Cash required for the refinancing decision. So let's be here. That's step number 1. You determine the incremental outflow, and that's the cash required for it to refinance. We say that you take core premium. How much is the core premium? Let's go to the 4th paragraph. The old bond can be redeemed at 10% premium, and in addition, a 2-month interest penalty will have to be paid on redemption. Yeah, the premium is 10%. We see that the core premium will be expressed in relation to the par value. So it's 10%. How much was the par value of the old bond? 100 million. That's 10. Then overlapping interest charges. The old bond you are paying an interest of? Let's see the first paragraph. Mark issued 100 million par value, 16%, 10-year bond. So the interest rate was? So you take 16% of 100 million, but 16% is per annum. But interest penalty is how many months? You are told that the old bond can be redeemed at 10% premium, and in addition, a 2-month interest penalty. Are you together? So you'll take 2% over 12. You take 16%, you multiply by the par value of the old bond, then you multiply by the duration. You just take 16, 2 over 12. You're getting? 2.67. Then you take the issuing cost of the new bond. Let's go to the 3rd paragraph. The 3rd paragraph. A financial analyst engaged by the company to assess the possibility of refinancing the debt report that a new 100 million par value, 12% 5-year bond can be issued by the company. Issuing cost of the new bond will be 5% of the par value, and a discount of 3% will have to be given to attract investors. So issuing cost would be 5% of the par value. The new bond is having a par value of how much? 100. That's 5. And then you add discount on the issue of the new bond. And you're told that a discount of 3% will have to be given. 3% of 100 is how much? 3. Then you raise interest tax shield associated with. Number 1 is the core premium. So our core premium is 10. Also, overlapping interest charges, of which we have is 2.67. An amortized issuing cost of the old bond. How much was the issuing cost of the old bond? Let's read the first paragraph. We are told that the bond was issued at 2% discount and the issuing cost amounted to. So let's be here now. The issuing cost was 2 million, but we are looking at an amortized issuing cost. We are told that this cost, remember, is a capital expenditure, right? Therefore, need to be amortized over 10 years. So you raise the unamortized. So if the issuing cost is 2 million, you raise the amortization, right? How do you get amortization? You will take 2. How much was the economic period? 10. We have been with this bond for how long? You multiply by 5 so that you get the accumulated amortization. What do you get? Achana nayo. Si ni half. A half inabakia ngapi? A half. The bond was to be amortized for 10 years. We have been in this asset for 5 years. So that's half of it. So that means half of that cost has been amortized. So the balance is 1. How much was the discount cost of the old bond? Was 2%, right? Of which 2% of 100 million is how much? But we want the unamortized. What has not been amortized? In short, is the net cost. It's for example, you have goodwill. You raise impairment, you get the net goodwill. Now that's what we are looking at. So you minus what? 2/10 times 5. You get what? Good. Add the total. 12, 13, 14, 14.67. Then that's the interest tax shield. So how much was the tax rate? 40%. So you take 40% of 14.67. 5.868. Good. So for it to refinance the new bond, how much do we need? So you take this, you minus 5 point that. That is 18, 19, 20, 20.67 minus answer. That's 14 point. Sorry? 802. Then we go to step number 2. We say that step number 2, you compare the cost of the old bond against the new bond. And I start by taking the interest expense. The old bond, we are paying an interest rate of how much? Just in the first paragraph. It was 16%. So it's 16% of the par value, which is 100. So that means for every year, they have been paying an interest of how much? 16. What about the new bond? That paragraph. Is it 5? It's not 5. 12? I put over paragraph 3. It's 12%, right? 12%. And the public will issuing 100 million. So you'll be paying how much per annum? 12. Then you raise interest tax shield associated with number 1 is the interest. So here our interest is 16. Here our interest is 12. Then amortization per annum of the issuing cost. Let's start with the old bond. How much was issuing cost of the old bond? Yeah, the old bond had an issuing cost of. Now, in this case, we're looking at amortization per annum. So you just take 2. How much was the economic period? 10 years. So how much has been amortization per annum? 0.2. Amortization per annum of the discount cost. We are looking at the old bond. How much was the discount cost of the old bond? Is this 2%, which is 2, right? So in this case, you're looking at amortization per annum. So it's 2. The economic period was 10. So that how many have they been charging per annum? 0.2. Now let's go to the new bond. An amortization per annum of the issuing cost. How much is the issuing cost of the new bond? It's not there, it's here. The issuing cost of the new bond is how much? 5. Then the expected economic period of the new bond is how much? 5 years. So how much is the amortization per annum? 1. The same with the issuing cost. I mean the discount cost. The discount cost of the issue of the new bond will be how much? 3. Then you are looking at amortization per annum. The economic period is 5. That's 6. 0.6. So how much is this? 16.4. How much is this? Then you multiply by the tax rate, which is 40%. You multiply by 40%. This one you're getting 6.56. So therefore, how much is the cost saving? Sorry, the net cost, that's 9.42, right? 9.42. 40% of 13.6? 5.44. That means you get 6 points. Yeah, 6.56. So how much, therefore, is our cost savings? Now let's be here. The net cost for the old bond, we have been paying 9.42. But under the new bond, we'll be paying only 6 point. So how much will be saving per annum? You take 9.42, you deduct 6.56. 6.56. You get an amount of 2 point. Yeah, this is what you'll be saving per annum. Then step number 3 was you evaluate using what? You evaluate using NPV. How do we compute NPV? Yeah, is the present value of cash inflow. You raise present value of cash. Present value of cash inflow. In this case, the cost savings will reflect to incremental earnings. So you'll take 2.86. You rediscount present value interest factor of an annuity. How much was the cost of the debt? Was 7%, right? Yeah, confirm, come on, 7%. Actually, that was in the last sentence, right? Yeah, you are told that the applicable tax rate is 40% and the after tax cost of the debt of the company is approximately 7%. In this case, we don't use the cost of capital since we're evaluating a debt. So it's 7% for how many years? For the remaining 5 years. Good. So 2.86, use the annuity table, 7% for 5 years. 4.1002. So how much will be a present value of cash inflow? Sorry? 11.73. So that's the present value of cash inflow. To get NPV, you raise present value of cash outflow. How much is the present value of cash outflow? Kavira is not there, it's here. Outflow is not in the notes. Eh? That's what we computed in step number? Step number 1. The present value of cash outflow was 14.802. How much is our net present value? 3.07, which is a negative, right? Now let's go back to the question. Required. A is the cash investment required for refinancing decision. Number B, annual cash benefits or savings of the refinancing decision. That was step number 2. Number C, NPV of refinancing decision. We have it. Now the question is it worthwhile to issue the new bond? Yeah, so it will be more expensive to refinance the bond. Assignment, November 2019. It was, let me confirm. Good. November 2019, question 4C. November 2019, question 4C. Open that question. Open that question now. It's November 2019, question 4C. So if possible, you can do the entire question 4. Question 4A is distinguish between the foreign terms as used in the context of derivatives market. One is the currency option and currency swap. Said what's an option? Is a contract giving rise to a, which gives the right to the seller or the buyer to buy or sell, the right but not obligation, right? Yeah, you can say yes, but you don't remember. Eh? Then we said, what's a swap? I remember giving you an illustration, what's a swap? Then number 2, we have interest rate swap and interest rate collar. You have them in your notes. And then hedgers and speculators. We said that hedgers are participants in the derivative market who enter to minimize on what? Risk. Speculators, they are the Kikuyus. What their work? They are there to make profits, right? Good. Then part B, that's a very easy question. Now let's go to part C. Smooth Drive Limited, a motor vehicle assembling company, issued a 10-year, 16% shillings, 100 million par value bond 5 years ago. The bond was issued at 2% discount, and issuing cost amounted to 2 million. Due to the decline in the treasury bill rates in the recent past, interest rates in the money market have been falling, presenting a favorable opportunity for the refinancing. A financial analyst engaged by the company to assess the possibility of refinancing the debt reports that a new shillings 100 million par value, 12%, 5-year bond could be issued by the company. Issuing cost of the new bond will be 5% of the par value, and a discount of 3% will have to be given to attract investors. The old bond can be redeemed at 10% premium, and in addition, a 2-month interest penalty will have to be paid on redemption. All bond expenses, including the interest penalty, are amortized on a straight-line basis over the life of the bond and are allowable for corporate tax purposes. The applicable corporate tax rate is 40%, and the after-tax cost of the debt of the company is approximately 7%. Is that question the same? Yes. Yeah, you see, this examiner even was not creative. He only changed the what? The name of the company from Mark Limited, and then they wrote what? Smooth Drive. Yeah. So I need to be very keen with the question that we usually do from the handout. Because after all, they have these materials, and that's what they used to set your exams. Eh? Yeah, bond refinancing was introduced just the other day, I think 2018. But I already had that question. You see, they set it on 2019. They changed nothing actually. They set it the way it is. Eh? Required. The initial investment required to issue the new bond. Number 2, annual cash flow saving, if any, expected from the bond refinancing decision. The net present value. Advise the company on whether they to refinance the bond based on your results in C3 above. So if possible, not if possible, for the physical student, I want you to do that question now and make sure you have an answer like this. Nothing else, even the figures are the same, right together? But don't copy what you have done. Try to understand that. Mostly here, this is where the problem is. I know the rest, once you have the format, it's just to insert that, but this is where the problem is. So can you do it now? Yeah, it's not an assignment and it's not a homework. You do it now.